Well, hello and a very warm welcome to this webinar on Auto ABS, brought to you by Scope Ratings. My name is Keith Mullin, and it's my pleasure to be your moderator for today's session. We have a fabulous panel lined up for you to take you through our topic today. And rather than delivering a long presentation, we decided to conduct today's proceedings predominantly as a panel discussion, although we do have some slides to lay out some introductory context. So our speakers will be discussing the performance of Auto ABS in Europe and giving their perspective on the outlook for this segment of the securitization market. And we'll also talk about the rise of EVs and the shifts in vehicle finance that are shaping risks and opportunities. Needless to say, our session today is extremely timely, coming as it does in the wake of the US tariff announcements, including the 25% levy on automobiles. With so many topics swirling around the auto ABS market, I'm glad we're in such competent hands today. So let me introduce you without further ado to today's panel. So please welcome Eddie Glusson, who works in auto and operating asset securitization at Crédit Agricole CIB. Bernhard Zahel, a senior portfolio manager at DWS. David Tuckenhagen, head of asset securitization Germany at ING. And from Scope Ratings Structured Finance team, Miguel Barata and Sebastian Dietsch. Hi, everyone. Welcome to you and thanks for being here today. Now, as our panel examines the auto ABS market, we'd also like to make this session as interactive as possible. So I encourage you to take full advantage of the questions function on the platform to write in questions as we go along, and we'll get to them at the end. So I mentioned we had a few slides we're going to show you to kick off. Today's slides will be available for download at the end of the session, and I'll explain how to do that a little later. So let's get started. Miguel, I believe you are going to kick us off. So let me hand over to you. I'll just maximize the presentation here, and perhaps you can run through the agenda and kick off.
Sure. I will try to cover what we have seen in terms of auto ABS and collateral performance, what we have seen in the past, and also a bit expectations. And I will start on slide 4. So here, I would like to highlight, auto ABS in the past has been always an asset class of choice, quite stable performance, characterized by low default rates and actually high recovery rates as well. There's been many transactions that we rate in auto ABS public space, but also on the private space, in particularly in Europe, where we have a greater fingerprint. And of course, here we even in periods of significant economic stress, for example, during the pandemic crisis, but also more recently during 2022, with the sharp rise in interest rates and inflation, this all created conditions for making it very difficult for auto collateral to perform well, in particular in terms of debtors' affordability. And here, what we saw actually was surprisingly good. So actually, we saw small increases in arrears, and the performance overall was actually quite strong. I think was another testament for the resilience of the asset class. Of course, would be important to a bit, if I can elaborate, in terms of what I think was been the factors explaining the resilience of asset class and how we, especially transactions post 2008, why did they perform so well in terms of collateral and of course the positive rating actions that we saw. Here, I think there is not a single answer. I think there is several aspects that explains the positive trend. In particularly, the structural features that we see presented in auto ABS, such as very common, we see sequential pay-down structures, which over time, as the transaction deleverage or as the transaction exits the revolving phase, it naturally builds up, mechanically creates support, and that leads to upgrades or to affirmations. Also, we have seen as well a positive asset selection, i.e., in many cases, the performance of the auto ABS securitization is actually better the performance that we analyze on the originator books, eligible assets to be securitized. And of course, this can be explained by effective and efficient restrictive eligibility criteria and also replenishment features that create a control environment for asset deterioration. However, I also believe that the nature of auto ABS, so here we're talking about very granular transactions. So obviously concentration risk is not so much an issue in these transactions. Also, transactions benefits from really short-term financing. So we're talking here of loans with an average of 4 years, which translates into portfolios of weighted average life of 2 years. And the fact that you have a very reduced weighted average life, it helps to reduce the macro uncertainties. Also, there are many other elements that we saw in terms of regulations. They support the performance of not only the autos but the market as a whole. In particularly, regulations such as imposed after January 2011, where we saw the minimum 5% risk rotation requirement, obviously designed to make sure that the interests across originators and investors are better aligned, and then therefore it's natural that we see more robust structures to try to prevent originators from having losses at the end of the day. So this better alignment of interests, this 5% rotation rule requirement, all of that, I think, has been designed to ensure that auto ABS is used as a funding tool, and rather than being a way to transfer risk for investors. So all of that, I think, was being developments from the regulations on the positive side. But of course, there were many others. I mean, we can even talk about regulations imposed in rating agencies, such as protection of analysts, everything designed to try to create a safer environment. Now, in terms of underwriting, I think underwriting also played an important role to explain the positive trend that we have observed. I think, and I believe, since great financial crisis, or since 2008, there was a trend for auto underwriters to be more restrictive, natural trend. Therefore, I think there were some lessons that have been learned, in particularly from auto underwriters. And we also saw a better use of risk models, a clear separation between risk function and sales activities, which itself should allow them to better understand or distinguish a bad from a bad customer. So all of that has been the drivers for positive performance. Now, of course, if we move into the following slide 5, it does make sense. I mean, if we have seen a strong collateral performance in the past 15 years, it's natural that you would see a greater number of affirmations and upgrades in these transactions. Even by looking to the number of grades, as we can see, for example, on the slide 5 bottom graph, it does not really tell you the whole strength of the asset class. As we all know, typically public auto ABS, they have 2 or 3 tranches, and the most thick senior tranche starts at AAA, so there's not really room for upgrade, rather more an affirmation than anything else. But here, just to give you a sense of rating actions in the auto space, and clearly they've been on the positive side, in particularly from 2013 onwards, even passing through the pandemic crisis and through the 2022 high inflationary period that we saw, which have obviously a negative impact in auto borrowers, and they've seen their income squeezed and affordability significantly reduced. Now, the following graph, I mean, just to try to illustrate what we have seen in terms of available transactions, in terms of outstandings of auto ABS, it does make sense that if this asset class has been performing so well throughout even different economic periods of stress, it's not a big surprise that we saw the size or the exposure to auto ABS in the total ABS market nearly double in between 2010 and 2022. So we see here a significant appetite for auto ABS, in particularly during periods of expected stress economic. Now, if we move into the following slide 8, sorry. Just to slide 8, just to a few words in terms of what we expect in terms of the European market here, not to be confused with other geographical areas, but here with a focus on Europe. I mean, I do believe, in particularly when we think in terms of transactions backed by private individuals, where we would pay more attention to unemployment, inflation, interest rates, being interest rates and inflation quite important in terms of debtors' affordability for paying their auto financing. I really think that the macro landscape for the time being is stable, if not positive for auto ABS. We expect a stable unemployment. We expect a slight reduction in inflation, perhaps with one exception for the UK for next year. But then the path or decreasing trend in inflation should stay. Also, interest rates are decreasing, perhaps not at the pace that some analysts or experts initially thought, at a slower pace, but still all of that should continue to support auto debtors affordability metrics. And this obviously it's favorable for the transactions of auto ABS outstanding. Now, in terms of residual value trends on the slide 9, here, of course, auto ABS, in particular, recovery rates and are affected by used car values. And also, when we talk about transactions who have a greater exposure to residual values being securitized, here the role or the performance of residual values takes more relevance. Here, I don't think what we're seeing in terms of residual values decreasing trend is a reason for alarm. I think this is just actually residual values going back to normal. Definitely what was not normal was the high levels of residual values that we saw in 2022 or 2021 as a consequence of the pandemic, of the supply chain disruptions, of reduced inventories of new cars and used cars. And all of that is definitely not the normal market. Here, of course, we are well aware of the recent events, in particularly on the tariffs topic. And here there is a real possibility for seeing, rather than the slow stabilizations of residual values, a slow decline throughout 2025 and 2026. It actually could be the case that if supply chain goes back to disruption, in particular European supply chains and OEMs, actually we can see pressures to invert the decreasing and make the decreasing and increasing. But of course, here it's still uncertain, still a lot to be seen. I think no one really knows at the end if this is a permanent tariff issue or this is going away in a couple of weeks. Is this a negotiation tactic from the United States? I think no one really knows at this stage, so I think still to be seen. But if anything, it could actually invert the residual value negative trends. Now, on the topic of the green, transformation. Sorry, here I will ask you for slide 12. I think indeed we are seeing some positive news particularly for the climate and for the world. And we're seeing an acceleration of electric vehicles in the market. Just to give you a few points, reference points, the auto market expects in 10 years' times, by 2035, the share of electric vehicles in the new light vehicle sales will be around 94%. So, of course, this is shaping the portfolios that we are rating. We are seeing transactions being presented to us with greater shares of EVs. Of course, when we talk about EVs, this is not just something happening in Europe, it's happening globally. Actually, if you can see on the graph on the right-hand side, if you look globally, the sales of EVs, what we're seeing in Europe is no different from what we're seeing in the global world. And in particular, we are probably 3 years behind what is happening in China in terms of movement towards EVs and acceleration of EVs. However, we do believe that it's still uncertain how fast this migration to electric vehicles will happen. As we saw in 2024, it depends a lot in financial incentives. For example, we saw in 2024 that the removal of financial incentives actually led to reduced sales of EVs in Europe. So this transition is very much depending on financial incentives and also the how much mature the market gets in terms of having EVs affordable and cheap, and reducing the around 30% difference between internal combustion engine and EVs. But here we have absolutely no doubt that we will see more transactions with EVs exposures, and this is where the market is moving. In particularly, auto ABS will be heavily affected by that. Now, touching a bit on the topic of the manufacturers, I mean, there is no doubt that there is at the moment an European difficult manufacture period. OEMs, European manufacturers are struggling a lot, especially a lot more since last week. But they were already struggling. I mean, even before the tariffs, we were seeing European manufacturers with poor sales performance in Europe and also outside of Europe, in particular in China, which is a very important market. And also European manufacturers were already struggling with the transition to EVs, right? So we all know that manufacturers have to meet certain CO2 targets. And if they don't meet those targets, there is a penalty, there's a cost. So all of that was already creating significant pressure. Now, I think it's important to understand that what happens in the auto world does not necessarily trickle down immediately into the ABS transactions rated. It does not necessarily has a negative credit impact. Actually, we have seen several crises in the past, not many years ago. If you all remember the pressures that we had with the Volkswagen emission scandal, etc., and actually the impact on rating actions was actually really small. Here, I'm not saying that we will not shape the supply of auto ABS. Perhaps we could see even smaller transactions if the offer of auto financing gets reduced as a consequence of the uncertainties and struggles on the auto manufacturer. But does it really has a negative impact directly in auto ABS? At the moment, I don't think so, and there's still a lot to see how it unfolds. With this said, I will stop here with my contribution about the past performance and recent trends in the auto market.
Great, thank you very much for those comments, Miguel. So I'm just going to minimize the presentation, but if any of you want to bring it up again, we can do that in a second. So we wanted to bring in our other panelists, and we've decided to split this into, because there's so many ways we can split this up. We've decided to do it by public and private ABS markets. And each of our participants is obviously aware of all, but has a sort of more emphasis on one or the other. But I wanted to come to you, David, if I could, first of all. And we're talking here about public auto ABS markets. I guess, again, Miguel covered a lot of ground there. EVs, residual values, mentioned capital structures as well in the rating part. Can I ask you what trends you observe in the public auto ABS market? And you can cover collateral structures, investor demand, and your expectations. So big, I guess, a big multi-headed question, but perhaps you can lay out some thoughts.
Sure. If we leave out the last 72 hours, happy to go a little bit like what we have seen so far, and then we can spend maybe a few moments on what we see right now, which is very difficult, I have to say. So overall, I think in terms of structures, a lot of stability. There's nothing really newly invented, I would say. If you look back the last 12, 24 months, there's some kind of mitigating elements which have been implemented, and they seem to be there to stay, like certain reserves only being posted on downgrade if the servicer fee is being applicable or not. So that seems to be proven. Back then it was like a little bit of a trick to mitigate low excess spread figures, which are now actually, when we look into the numbers, swap rates are going down. Let's see where the market is going at the moment. But overall, given the portfolio composition, the average yield has kind of caught up quite significantly. Excess spread is again back, and hopefully to stay there as an additional cushion to protect against defaults. In terms of portfolio composition, I think we see the natural migration, which typically takes some time to feed into the portfolios. Electric vehicles are increasing, but everything is, I would say, largely following a logical trend in that regard. In terms of residual values, I tend to agree with Miguel, but there's a lot of uncertainty right now, and we don't know how this all will play out. I think it's fair to say tariffs could have an impact on residual values and I think it's proven to be seen what happens there, but there are multiple layers. One is like obviously cars, if they're exposed to any tariffs, are becoming more expensive, which could help on the used car side. But at this stage, looking into the European market, there are no tariffs increased since then. So what you could expect is a little bit of a swamping of new cars moving into Europe because they're not being sold into the US at the moment. So they might, at least in the short term, push cars into Europe and then create some sort of oversupply. Likewise, Miguel, I think, is right to say we need to see what happens on the supplier side if we see further disruption. So in the end, you see on both sides things moving. But overall, what we can see in terms of residual values, they came down from very high levels. At least recently, the movement has reduced. It's still quite negative compared to 24 months, 12 months ago, but it slowed down. What you see between the engines is like battery is really way off. So they are 10, 15 percentage points lower than the internal combustion engines on average, I would say. So that's clearly they're lagging behind. You can hope that the RVs have been set conservative enough to capture these kind of risks. In terms of investor demand, okay, so far we have seen very robust levels on the mezzanine, so coverage extremely strong. Most recent deals have also seen, I think, decent coverage on the senior side, which has been proven to be a little bit more complicated in 24. So that has been quite solid. Right now, we need to see. There is little in the market at the moment, but we need to see how the market develops and take it from there. So we are living from one day to another at the moment.
Okay, very good. Sounds rather precarious, but I guess given the moment we live in, reasonable. Bernhard, as a guy, I guess, on the hook to invest as an investor, perhaps talking more generally, the current ABS structures, auto ABS structures you see coming to market, do they kind of meet your requirements? And if, bearing in mind you have two sell-side bankers here, what is it that you're missing that they could take back to their clients?
Maybe the last comment David made was quite a good point I could take on, the demand point. And I think this is quite an interplay between supply and demand. If you ask me what I'm missing, I would say the current deals I'm seeing in the market, I'm not missing really something. They are serving my demand. What I'm missing is more supply. And it is right what David said, particularly towards the end of 2024, that it appeared to me that the deals being in the market were extremely well covered in the subordinated parts of the capital structure. And towards the end of the year, they seem to be covered in the senior parts, but not extremely oversubscribed. When I look into this year, that turned a bit until, let's carve out the last couple of days. But the last deals that have printed still have been well printed also in the senior parts of the structure. To give you an example, end of last year, it looked a bit like they have just been covered. Earlier in last year, they have been well covered, twice subscribed or something like that, maybe on average. Looking into this year, until, say, March or so, even the senior parts of the capital structure often have been covered 4 or 5 times. And when we are looking into the more subordinated parts of the structure, of the deals I've been looking into at least, they sometimes have been covered 10 times or even more. So that shows that there was heavy demand for those types of transactions. And that brings me to my initial point. What am I missing? More supply to some extent. And when I say more supply, it's not just the overall number in euros of auto ABS being placed in the market. It is also a general topic. It's not only on auto ABS, but also on the other big asset types in the European structured finance markets. But it is also the availability of by standard not only the senior tranche but also maybe a single A tranche and a triple B tranche, the subordinated pieces. Sometimes you just see the senior part being placed with external investors and the remainder being retained. In other cases, you see it all being placed, but it's a bit deal by deal situation, and that could be delivering more, selection possibilities for me. And the other dimension of this is the availability of European countries in the market. There is a clear focus towards Germany and towards maybe 3 other large supplying countries, but that's it. And it could be, in an ideal world, being broader diversified into the markets. Now you might be asking me what are, in your eyes, the reasons for it. I think that question is something that best originators could answer, but I also obviously have an opinion on that. And I think when comparing pre-GFC financial crisis and today, you're right, Miguel, when you elaborated on the safeguards that are now in place. But at the same time, you could argue with the default statistics, particularly in European auto ABS, which have been stellar, including before GFC. But what you can clearly say is that there is a lot of burden also, particularly probably on the originator side, to be able to place something in the market. And the same is true to some extent for the investor side. And when I say burden, it's not that I'm advocating for reducing safeguards or reducing standards. It's more about bureaucracy, which is in play. And with that, I would hand back before I open too many topics.
Yeah, you have quite a few there. Thank you. Edith, by all means, respond directly to Bernhard, but perhaps the follow-on question, which I guess it's a natural one, is now, given the change that we're seeing in the OEM market, could you talk to the growth potential you see in auto ABS, but also perhaps some of the challenges? And bearing in mind, Bernhard, let's say he represents the buy side, champing at the bit for more supply, more countries. So, that's you can take that as the demand will be a given. But what are the opportunities and the challenges?
And I'm glad to hear Bernhard saying he wants more supply, because as OEM shift toward EV, there's certainly a potential for a new supply, new type of transaction. Of course, you can think about issuance backed by auto EV or auto loan or lease, but you see also new type of issuer looking at the market beside traditional OEM, including in terms of countries, which could also bring some new investors, in particular in Europe and Asia, and come with new risk profile in terms of transaction. You also see a little bit of change in the business model with subscription business or different type of car sharing type of business, which could lead to new type of auto ABS. The challenge is that it definitely gives rise to more complex structure, higher risk, which you see already with EV cost increasing, leading to longer duration. So the point is really to understand what balance the market can accept between a traditional auto ABS, which has been very safe and stable, and the new initiative and figures which can translate into higher risk in the transaction.
Interesting. Before I hand back to, I want to go back to Miguel and Sebastian. Before I do, Bernhard, how does that sound? More complex and higher risk. Does that float your boat?
Well, I think it is clearly important to have new developments being reflected also in the supply in the markets. And I have been mentioning that sometimes you're missing the subordinated parts of the structure, which by definition carry more risk than just the AAA rated senior piece of a certain transaction. You could also get more risk by having new technologies in place, like electric vehicles, where you don't know exactly whether residual values are, or new countries, maybe new lender types, and so on. But here we are getting to another split of the market. At the moment, I think those types of things are mainly happening in the private markets. And it is also the traditional, known, standardized types of transactions which partly do not share the risk with the market for whatever reason, even though the demand for the risk is extremely strong. When you look into the subscription levels of the recently placed transactions, and when I say recently, that is a trend that we see for the last couple of years, maybe at the extremist in the more recent past, but even if you go back 2-3 years, that was the same story, because everybody in the public markets, not in the private markets, but in the public markets, is playing the senior piece, which is the largest part of the structure, but only part of the originators are willing to place the junior ranking pieces. But yes, okay, if there is something new, like new technologies, that is obviously also always welcome, even in the more liquid parts of the market, because at some point they will transfer, in my eyes, to the more public way of placing them and widen the supply, which is always good if you have selection in the market.
Indeed. Okay, well, we'll talk about the private market in a moment, actually, Bernard, but thank you for those comments. But before we do, let me throw it back to Miguel and Sebastian. So do the trends that have been articulated so far, or what kind of impact do they have on the risk you perceive for auto ABS transactions?
Well, I can start first, and then Sebastian, feel free to complement. I mean, for me, at least in my way of seeing the transaction, I mean, there's no doubt that there will be more EVs being securitized. Also, I mean, I think indeed there are some other additional risks and things that the rating agency needs to ask themselves in terms of understanding all the positives and drivers for EVs residual values. But I think at the end of the day, perhaps not in the next 2 years, but it will take a bit longer as EVs mature and become the norm car to have, right? And you see the technology progress is not being so fast as they are at the moment, right? So I bought my car 2 years ago, for example, a plug-in electric vehicle. It had a 50 kilometers range. Now the new models have 110, which obviously makes my car not attractive. But if we see the stabilization, i.e. this technology starts maturing and everybody has long range, 1,000 kilometers, perfect world, and fast charging in 5 minutes, then I think EVs will depreciate as much as any car, and cars, they do depreciate a lot, and that's not going to go away. So, I mean, I actually, even now, if you ask me, if we think in the underlying borrower who goes for an EV, I don't necessarily think that the borrower has a higher risk profile. Because why is that? I mean, very simple. First, the loan is naturally higher, so the more scrutiny from the auto underwriter. So before they approve the credit, they do more checks. Let's put it this way. Secondly, a borrower who has an EV car actually has a lot of savings. So indeed, he's paying 30% more upfront, but then throughout the life, we all know that running in EV costs a fraction of the price, and from zero, very close to zero maintenance, except changing wheels, and savings on road tax, savings in expensive cars, annual tax, etc., etc. So I mean, I'm not so negative or scared of seeing future transactions with greater share of EVs. And I think this is just natural to happen. And I think rating agencies can cope with those risks. And also the structures, the arrangers, they put in place robust structures which well define the maximum exposure to electric vehicles in the pool. Also revolving deals, they continue to benefit from well-defined thresholds combined with the same classical performance triggers. So in any way, if the transaction deteriorates, you just go straight away out of the financing, so the transaction ends. So I think we should embrace this more risky type of products. Also, I don't see problematic seeing more structures with more junior, more risky parts of the capital structure. In particularly with a long track record that AutoABS has and all the safeguards. And the safeguards, some of them that we mentioned so far, is probably just part of it. There is still a lot more. We could be here for hours talking. So I think it's just going to happen. I wouldn't see a problem of trying to support EV growth and more transactions that satisfy the demands of investors. And I hope this expands outside of the private market to the public market. I think normally it will happen. Just a question of time.
Yeah. Okay. Anything to ask, Sebastian?
Yeah, maybe just adding to that and actually touching on one of Bernard's points. So I think given the well-establishment of the asset class, I personally actually like it that particular originators don't push it too much in order to put too much on the market when they have to compromise maybe on one of the safeguards that the asset class actually has, which is indeed to a large extent positive selection of the assets. Of course, if there is the investor demand for that, maybe one starts this then, and we're going to that in a second, more in the private space. But basically, I would personally don't like to see the quality of the asset class compromised by originators actually pushing it too far, and because it may come with a lot of consequences. You may just create a new normal, so where basically then everything that is known as track record is basically not worth anything anymore. Therefore, I also like, and we have seen it, that actually the shares of new risks in the transaction are actually transmitting slowly into the transactions. I mean, yes, I have seen transactions with 50% electric vehicle share, but overall, I think we are still at the point where that particular technology is exactly on the transition from a niche product to a mass market product, where then all, in particular in the mass market, we will then actually see on the one hand all components stabilizing just naturally, but the question still is, I mean, a lot of technology uncertainty. How does it in the end pan out with the market data that still for the entire asset class will be an important cornerstone of analysis and investment decision.
Yeah. Okay, yes, indeed, that makes sense. Now we'll talk about the private market in a second, but before we do, David, can I just bring you in on this general point about originators exercising, let's call it restraint, in terms of not pushing too much into the public market? Do you just want to comment on that?
Yeah, I wouldn't say it's so much they are holding back collateral to bring it to the market. I mean, they have their general funding plans, and ABS is being part of it. When Sebastian was a little bit alluding into like expanding a little bit the boundaries and making the structures more aggressive, I think there's too much franchise to lose to compromise on anything like that. So it's very established platforms, and Bernard might agree, they like to see the repetitiveness, the kind of like-for-like comparison under the platform deal. So there is naturally very few degrees of freedom you can introduce. So in that sense, I think there's little to grow except for like more originations, i.e. more car sales. But when looking into the numbers, the registrations are not pointing into a massive growth after the pandemic. So it's a bit of a subdued market at the moment, slowly growing. And yeah, let's see where the economic situation leads us in that regard.
Yeah, indeed. So when it comes to private ABS, and I guess here we're talking about new issuers, new manufacturers, and potentially, as we've been kind of alluding to, new vehicle financing solutions. Edith, can I come to you on this to kick us off on this segment? Just on the basis that I guess you see a lot of features and trends tested, for want of a better word, in the private market before they go to the public market. Can you just talk to us generally about the current trends that you see in the private ABS market?
Thanks, Keith, and happy to take that. I just would like to come back on what David, Sebastian said about the auto public ABS market. It's a very sound and solid market, and typically what we see in the private market are two types of transactions. First type of transaction that are refinanced in the private market temporarily with an aim to go public at some point. This can be because they are smaller size, developing company or developing business from established company. The main point about going public is generally the lack of data. So you need some time to accumulate and test the data to be comfortable to go into public type issuance. But we also see some transaction being financed in the private market and not being able to be refinanced in the public market, at least until now. The two main type of transaction that comes to my mind are rental fleet, inventory financing. Those transactions have been refinanced in the private market for a while. You have quite several billion of potential transaction across a different type of transaction. And there is, for instance, in the US, a public established market for rental fleet, which doesn't exist in Europe. These transactions are a little bit different from the auto ABS market. Senior tranche are usually not reaching the AAA standard level. They may be multi-jurisdiction risk, so with higher risk, including on the senior tranche. And Bernard, I concur with what you said before. We see more appetite on the mezzanine sometimes than we see on the senior. So the main point is really to determine whether the senior can be placed into the market and placed to the market at condition that was it for the issuer. Also, because there are maybe higher risk transactions, we try to protect, and sorry, my light is disappearing. We try to protect the transaction with multiple covenant triggers, which means that these transactions are or require tighter monitoring and attention with potential waiver that doesn't really fit with the public market.
Yeah. Okay, cool. And Bernhard, from the investor side, is there, I guess, speaking personally, but potentially speaking for the buy side, is there demand that you currently see only being satisfied in perhaps more bespoke, non-public settings?
Well, I'm mainly active in the public markets, but when I take up what Edith just said, and leaving aside the first example where the track records first need to be established, and that being the reason to start in the private markets, you are being left with situations which need more, say, less standardized, more bespoke types of structures of mechanisms in the transactions. Whereas when I'm looking into the typical public transactions, they have the intention to be as standardized as possible, which brings with it also a very good liquidity in the markets, because it's by far less complex to get the risks within those. This part of the current private markets, which is for now too complex, might at least partly develop in a way that you can come up with that standardization once the technology is more established, for example, and thereby the types of transactions are better known, the types of structures, and the funding costs for the originator and vice versa are possibly being reduced to a level which makes sense to place them in the public markets as well. And that would be a very good development again, because by that you will have the asset class being more diversified going forward. And towards the factor that has just been mentioned on the availability of juniors, I fully agree. There is only the part of the market, particularly of the large OEMs, where there is from the originator side just not the incentivation to get capital relief or partly capital relief, and auto ABS being purely used as a funding tool. And that, from my perspective, sadly brings with it that there is just nothing subordinated to be invested by investors, by public investors. And that possibly could be changed, but the question is what needs to develop. And final remark, the comparison with the US is sometimes interesting to be seen, and particularly when you have things being able to be placed in public markets now in the US, which is not the possible now in Europe, raises the question, why is that? Is it because the capital markets have been developing further in the US compared with Europe? Is it because the assets are better known? Do you have a better investor base there? There's a multitude of possible answers to the questions. Probably there is not the one answer, but that would be an interesting look when it's coming to the question what needs to be done here to broaden the market and to make life easier for everybody involved, the investor side, but also the originator side. Because it's not only there is a lack of supply, don't take me like that. I'm aware of the fact that there is a limit of investors into senior pieces, which limits the supply to some extent. But it's not only attaching the one or the other side of the table. I think you need to move on both ends and make the participants, bring them into the position to be able to move.
Yeah. Okay. Yeah, absolutely. Look, let's perhaps steer clear of US versus European capital markets, because that's another full day session. But you're right. It's instructive to look at something. Yeah. David, again, looking at the private market, and perhaps following on from what Edith was saying a little while ago, is there anything specific you see that could move from the private into the public market? Let's call it soon, and soon you can define as a month to a year, but whatever. I mean,
let's stay more in the 1 year. I think Edith made the very valid point. It's like there are two worlds in the private world, if I can classify it as such. So one is really like they are started as private and they're supposed to be private, likely because of complexity, rating caps, bespoke nature of assets and structure. So typically they remain on the private side. But at the same time, there are some players which basically, due to the lack of historical data, getting also acquainted to the technology of securitization, do it first in the private space and then naturally roll into the public space. What is that? It's typically the classical loan and leasing contracts, which are self-amortizing, interest-bearing. So quite simple and standard collateral. And there have been some precedences recently. I mean, I think most recently, to my knowledge, the Auto One structure, which started as a private nature and then moved into a public deal, quite successfully. Local Tapiola in Finland started with warehouses, and then I think now the 6th deal. So there are precedences, but these are, I think, looking back in the last 5 years, maybe a handful of them in the auto space. I would be surprised to see a new OEM coming up and financing in the next 12 months. So, but in that sense, I think there is something happening in the private space. The volumes are quite large for the kind of ramping up and then being ready for the public market. On the contrary, we also, and this will remain as a private space, A lot around subscription, very likely, because there's a lot of material flying around and being produced, but they're typically not being rated, or if rated, then not high investment grade, bespoke structures, different complexities around cash flow mechanics and legal aspects, multiple jurisdictions. So looking at Bernhard, I'm not sure how big the appetite is for those kind of assets, even if being rated AAA. Just the time you need to spend to get acquainted to these structures is just, I would say, material. So in my view, where you would see public deals is in the classic simple collateral space, loan and leases. I think what we have not seen, and which is a quite significant market in the US, it's not cars, but trucks. That's could be something to come at some point. And if we speak about the larger mobility space, bike leasing is always something which could come in some sort or another, but that's not a car anymore.
Indeed. Okay, Bernhard, do you want to just do a very quick response to David on that last point very quickly, because we are running a bit over time.
Yeah, I think he's right. There is a use case for both parts of the market, and there has always been a use case. And I wanted to just make the comment, when you look at the broader European structured finance world, I think autos is one of the better functioning parts of the market. If you look into SME financing by banks, that's a different story. There is less being around, or corporate leasing or something like that.
Yeah, okay, absolutely. We'll move in a minute to our perhaps concluding remarks. We're running close to our hour, but let me just throw it back to Miguel and Sebastian, because we talked about some trends in private markets and the transformation of those into public transactions. But taking the trends that have been mentioned so far, will those trends find their way into rated transactions? And then briefly, what analytical considerations on top do you anticipate?
Okay, maybe I can take this, because some of those transactions have indeed hit my desk in the last couple of years. No, I think it's relatively clear that the concepts are generally first tested in the private markets in order to not impair by any means the track record that Auto ABS has in the public markets. Now, what we have seen at Scope is indeed, as Edith has indicated it, several types of transactions that are all broadly related to auto securitization or auto-related securitization. So not necessarily only loans or leases as an underlying, but then also going into the direction of of inventory finance. And even trade inventory finance. So from that end, you basically get essentially the full spectrum related to real asset up to the actual financial product, and then everything in between, including then also certain maybe rental contracts or head lease agreements, or you name it. So from that end, I must say, for us, it has always been important to essentially understand the fundamentals, both of the transaction, but then also the fundamentals of the originator behind, which clearly do not always come from the 100% well-established, or well-established in the sense everyone knows them, and there's a decade-long track record, but basically who have built their business model one way or another around auto finance or auto related services, I would all in say. And here basically for us has always been the approach of understanding what are first the fundamentals of the contracts behind, but then also how the different structures are then essentially equipped to cope with these risks. And indeed, because track records, data is sometimes scarce, particularly in the US, and probably that's actually also one of the reasons why things are more prominent and more in the public markets in the US, because of data availability, and here, particularly in Europe, also given cross jurisdiction, not everything is aligned. A vehicle in Italy may not have the same specifications as in France, therefore you cannot move one to the other. Even though we also have there seen business models that basically try to treat this as a commodity and then basically do a business model around this. So from that end, these fundamentals and also the information around it certainly makes it more difficult for us to analyze it, and generally also takes a bit more time in the analytical process. And certainly because also of that streamlining, that's or lack of streamlining yet, that's also why it stays for the moment in the public markets, in the private markets, and not yet touches everything and transitions to the public. Keith, I think you're on mute.
I'm indeed on mute. Thank you for pointing it out, Sebastian. So we need to move to our questions. I'm just conscious of our time, but Miguel, do you have any very, very brief add-on comments to what Sebastian just said?
No, I think most of it was indeed covered well from Sebastian. I mean, and indeed also perhaps some blame on the rating agencies, because we do require a lot of historical data track and data record. So sometimes transactions will only have 1 or 2 years. It doesn't work for us. So there is as well, of course, some blame to the rating agencies and not facilitating sometimes some transactions happening, and unfortunately it's the way it is. But indeed for us, data track record, long data track record, it's important. Of course, it's not just about quantity, but also about quality. But this plays, for us, it plays a central role in our analysis, and I don't think that's going to change, unfortunately.
Fair enough. Okay, but I guess being thorough can never be. You can't assign blame to being thorough. But let's move to our. We've got a few questions. Like, some of these questions may have already been answered or touched upon, but let me just throw them out there if I may. And again, they're not aimed at anyone in particular, but feel free to jump in on these ones. So the first question, I'll take them in the order they came in, which we have kind of touched on. Do you expect used car prices to go up given the recent tariffs, leading to more expensive new cars and consumers therefore opting for used cars? Anyone on a brief comment?
In the scenario that tariffs are being applied to these cars, that's a quite logical function. However, in my view, there are multiple layers, and you need to figure out what is dominating in the end. So it could be going in that direction. I think at the same time you have some counter effect. So I don't know, is in my view my answer, but maybe others have a different view there.
I mean, if I may add in, so indeed, if basically new cars become scarcer, then basically used car prices will generally benefit. However, if the overall impact is then also impairing affordability, so that demand overall shrinks, then we're probably overall in a bit different world. So that particularly if then demand for cars altogether actually goes down. So as David says, it's not yet clear. Maybe in a few days' time, when everyone sits on a negotiation table, the environment might have shifted again. But if it really comes like it is, so I think there are in the end short-term effects that probably give benefit to the price of of used cars, i.e. pushing them up. But if overall there's a macroeconomic impact that puts a burden on all of us, then will be a new normal then.
Yeah, absolutely. There's a question here which I'm suspecting may be a bit difficult for us to answer, but for the benefit of the questioner who took the time to put the question in, let me read the question, and perhaps I'll say to the questioner we may need to circle back to you after the session, which we will do once we have an answer. But let me ask the question. If anyone's got an answer, then shout out. And the question is asking us to go into some detail on whether we see any trends in different jurisdictions on used car prices by fuel type, which it sounds a bit specific, i.e. do some countries have better or worse EV performance than others for any jurisdiction-specific reasons? That's a tough question, but anyone want to proffer a response, or should we park that one for now?
Yeah, we can. I can answer part of it. I think the slide 13 that we have helps a bit into answering to this question. I mean,
there we go.
I think here on this graph, particularly, we can see. I mean, what this graph is trying to do is to assess the electric cars, EV depreciation versus all the market in terms of powertrains. So basically here, currently we still know that the market is mostly petrol and diesel. So it's a way to see how bigger are the depreciations in EVs. For example, here we can clearly see that we have a winner. Italy is definitely the jurisdiction across the main Western jurisdictions in terms of cars. And we see clearly Italy here with around 35% additional haircut for EVs. And actually the trend was on the increasing side. I mean, answering what could be behind these reasons, I mean, some of these reasons, I mean, are obviously to do with the removal of financial incentives. So, for example, if in Italy, if there were in early phases or some years ago incentives to buy an EV and benefits that you could have as a user of an EV, if those incentives are removed, or those savings that you were getting every year that are removed, then obviously you would not feel so much attracted for an EV car in Italy. Also, as we all know, there's been, in particular on the plug-in electric vehicles, which are part of the electric vehicles category, there's been actually some oversupply of those cars, and also a lot of cars that suddenly they come out with new versions that have longer ranges, and that makes completely obsolete the previous model. So, I mean, there are different reasons, but clearly, for example, we can see that, for example, in Italy is where we observe higher EV depreciation rates comparing to other jurisdictions. But of course, its own jurisdiction has a bit its own story. But indeed, for example, in this case, we can see Italy at the moment is the winner on EV depreciation.
All right. Sounds good. Thank you, Miguel. Next question, and I guess this refers back to a slide that, Miguel, you showed at the beginning. Have you seen any variations in performance between the different European countries? If so, how would you explain these? I'm assuming that's ABS performance.
I think in terms of ABS performance, I mean, I don't think there are obvious differences. I mean, I don't think there are material differences. Of course, okay, if the question is about residual values, indeed there are different significant differences, and either even not just when we talk about EVs, but also when we talk about residual values and the recent decreasing trend that we are observing. There are some, obviously, there are differences across Western countries, the main Western countries in terms of automobiles. But really, auto ABS transactions, I think the answer is no. There is no obviously differences. Just because residual values are going down, do we see more downgrades on the transactions of certain jurisdictions, residual values and EVs? Not really. For the time being, not really. Why can this be explained? I think just to answer a little bit, because that's probably what some listeners are asking. I mean, most part of these transactions, especially if they have, simply if you have an auto pool where the residual value is securitized and the value of the market values of used cars has a lot of impact. Typically, rating agencies decide a specific residual value loss, and that residual value loss has market value decline, rating conditional haircuts. So basically, it can sustain a significant negative trend in residual values. So it's still, there is a lot of embedded credit support that captures residual value risks and market value declines movements. Yeah. So that's why you don't see any meaningful difference.
Maybe adding to that, I think for each European jurisdiction, the auto ABS transactions have essentially found a little bit a steady state, if you want, reflecting the natural or the typical performance in the underlying that you see in the respective jurisdiction. Therefore, basically you basically see it on the structural mitigation side. That deals that you see or levels of defaults, levels of excess spread, etc., then are indeed a little bit different across jurisdiction, but then essentially are addressed on the structural side.
Yeah. All right. So we've got a couple more questions, and we're going to have to move to our very, very brief concluding remarks. But the question is this: do you see any area of the auto ABS market, i.e., country level, structure level, being more vulnerable to the current macro shifts? I guess the obvious answer is a bit early to say, but does anyone have any kind of like just things they want to throw out there that have crossed their mind in the last week, particularly?
I mean, I think obviously knowing Germany is if I may answer a little bit, I mean, I think obviously Germany is by far the European country that sells more cars to the United States. So obviously, if we are worried about European manufacturers selling less cars in the United States for the time being, then of course Germany clearly here, I mean, the numbers from my memory, it's around 25 billion US dollars of annual sales into the United States related to the sales of vehicles, or basically US imported vehicles from Germany. So here, of course, Germany is highly exposed to this. But again, as I said on my part, I think I think this will definitely put a lot of pressure in German manufacturers, in particular. But I don't see necessarily this having a direct impact on the ABS outstanding with collateral from Germany. I don't think, at least for the time being, it's not going to be a direct hit. And probably, again, because as we said before, we don't even know how this is going to unfold. We don't even know if this is permanent or not, especially coming from Donald Trump. Yeah, so there's a lot of question marks here. I think it's still to be seen. But definitely Germany, in terms of auto sector, yeah, definitely that's more at risk here.
Maybe
cool.
To add one layer, I think one thing what really drives defaults in these kind of portfolios is unemployment rate for private individuals or insolvencies for SMEs. So these are the key driving factors. So that's what I would be looking out for. Any material movements on the unemployment side, inflationary pressure, household expenses going up. These could be the trends. But to be frank, we are starting to see some weakening, very early stage, but we are moving from very low levels. So it's really far away from any levels observed in 2008-9, which anyway did not lead to any defaults in the AAA pieces at all. So.
Yeah. Okay, then we need to stop in a minute. David, I know you've got a hard stop, but before we let you disappear, can you just give literally a 30-second, what's your outlook, relevant, what's your concluding remarks before you have to run?
Yeah, look, I mean, we talk about the most stable asset class in the securitization space in Europe. So AAA pieces, household names, very established volumes, solid investor base, despite some weaker coverage on the senior notes. But overall, we look into a healthy market. We see now a lot of noise, and don't forget about it's largely on the originators, not so much on the collateral pool. So we need to see where this is going. But overall, I'm quite optimistic. This is going to be remains the kind of key asset class for European ABS.
Sounds good. All right, David, if you have to run, then feel free. We'll just carry on with our concluding remarks. But thank you so much for being here anyway. So, Edith, let me come to you if I may. Just a very brief concluding remarks on your outlook.
No, same as David, I think the market is stable and sound. We see a lot of initiative in the private market, but I think most of them will probably stay private, at least in the coming months. And it's important to take some time before the market can be educated and some new change can be brought to this very stable and high quality asset class.
Yeah. We go, Bernhard, what would you leave as your takeaway?
Much has been said already by David and Edith, so I can echo that. In addition to that, I would say, or I would point out that particularly under the current stress in the markets, that we are having here a very proven and transparent instrument that has been tested a lot over the course of the last 20 years, not only in the global financial crisis, but think of the Euro crisis. And when you're looking particularly in the auto ABS sector, which is, well, a lot of it is being reflected in in private individuals as the ultimate borrower, the credit performance has been stellar, and not only the credit performance, also the pricing performance over longer term. So if one takes that, I'm getting back to my initial wish list for more activity from both originators and also investor side in the market. The market is not small, but it is improvable in terms of size. But currently there is a lot going on that makes me relatively optimistic, not talking about the last couple of days and the tariffs topic, but outside that might be reason to be optimistic with regards also to having stronger activity coming up.
Okay, let's keep the feel-good factor going then. Let me throw this back then to Miguel and Sebastian to take us to our conclusion. Can you be very brief and give your outlook?
Yes, I mean, as you have to see it here on the slide, so basically our outlook is indeed also stable to positive. Indeed, a lot of the factors 2 days ago would have looked a little bit different or look like this, and now basically get a little bit of a question mark. But I think all in, as it has been said, so stable to positive is clearly what we're expecting to see for auto ABS. I think one overarching trend in the next couple of years indeed will be the green transformation that you will see in the portfolios. And here essentially the uncertainty both that we need to address analytically, and certainly the structures need to address one way or the other, then indeed by, on the one hand, how quickly do the new vehicles, the new technology build track record, while on the other hand, how quick or slow is it basically then transmissioning based considering build up of infrastructure around it, and then of course also the political will of all parties involved.
Oh, political will. Oh dear, let's not go there. Miguel, let me give you the brief final word.
No, I think there's very little I can say at the moment about the outlook for auto ABS. And I'm still, as Sebastian, definitely stable to positive, probably a bit more positive than some others. And let's see how it unfolds. And of course, I mean, now I think the next weeks and see how this issue about the tariffs unfolds, I think it's going to be determinant, and also to understand, as David mentioned very well, implications in terms of macro and on the variables that could afford afford pools of private individuals or pools of SMEs, and let's see what happens. But I think for the time being, I would keep my positive outlook as a final wording.
Okay, good. That's a great final word. So let me close the session there. Thank you so much to all our speakers for some fantastic and very insightful comments at this quite difficult time. I think you handled it extremely well. So thank you for your transparency and your thoughts. Thank you also to our esteemed viewers. Looks like many of you actually stayed to the very bitter end, which also proves to me that the content delivery was first rate. So thank you very much indeed. I did promise at the beginning that you could download the slides, and let me briefly explain how to do that. At the bottom of the screen, you'll see a button which says apps on the right-hand side. If you click on apps, you'll see handouts pop up. If you click on handouts, hopefully you should see a PDF download, which I'm not seeing, which is not a good sign. And so,
I
not to
can
worry.
see it.
I can't see it. It hasn't gone off my screen, but I've got a very slow internet. Oh, there we go. It's there now. Thank goodness for that. So please feel free to download the slides. If you have any questions that didn't occur to you during the session that occurred to you afterwards, feel absolutely free to contact any of us on the Scope side. And if there are questions for any of our non-Scope speakers, then we will certainly reach out to them to see if we can get some post-event dialogue going. And then final thing for me, bearing in mind that we are potentially at the beginning of, to use an awful cliche, a new paradigm in global trade and economics and markets. We won't even talk about stock prices. I think depending on what happens, we obviously will continue monitoring the situation, and as appropriate, we may come back at some point later in the year if we need to update any of the thoughts we delivered today. So between now and then, good luck out there, be careful, and all things being well, we'll see you next time. So it's goodbye from us, and again, thanks again to our speakers.
Thank you.
Thank you as well.
Thank you very much.
Pleasure.
Thank you.